Welcome back to the Retire with Confidence podcast. As always, I'm your host, Dave Zaegel. And today's episode is again sponsored by CWOs for Hire, which is the financial planning firm that I co-own. We are in the middle of our tax and client planning season. So right now we are not accepting new clients. But if you're looking for help, I still invite you to get on our calendar. You can do so very easily by going to cwosforhire.com and clicking on the link to book a time. And we're still happy to have a discussion with you, get the ball rolling, and we'll start bringing on new clients again in April once the tax planning and client planning season slows down a bit. So this is the third episode of our life insurance planning series. We've talked about different types of plans. We've talked about how we can use them advantageously in retirement in certain situations. And in this third episode, we want to talk about using life insurance for estate planning. So now we're not talking necessarily about how you can benefit, but we're talking about how others can benefit after you've passed away and how to structure this from both a tax and legal standpoint to benefit those people. So there's two ways that we're going to talk about. The first most common way that we see life insurance used is to avoid or to help avoid estate taxes. So right now, the estate tax limit is pretty high, meaning that you have to have a pretty good chunk of assets being left behind for it to be subject to estate taxes. Now, estate tax rates are pretty high, but again, just right now, the threshold that you have to get over is also pretty high. And so people often think, well, I don't need to worry about estate tax because I don't have that much assets and it won't really matter. The key is we have no clue what that estate tax threshold is going to be when you pass away. We know what it is now. We actually know that it's going to go down in 2026 because the Tax Cuts and Jobs Act expires in 2026. So unless Congress does something proactive to change this, we know that that Tax Cuts and Jobs Act will expire. And actually this estate tax threshold will automatically decline significantly at that point in time. Now, it still might be higher than some people have in assets, and that's totally fine. But the point is, we still don't know what that law is going to be because Congress can change that amount and has at any point in time to whatever dollar amount they feel like. So all of us need to have some thought of estate planning in mind if we're going to be leaving assets behind to a beneficiary or a charity or whoever we're leaving it behind to. If we don't want it subject to some pretty high estate taxes, we need to be having these thoughts in our mind from a planning perspective. So the most common way that we see life insurance used to help avoid estate planning taxes, not estate planning, estate taxes, is by using something called an irrevocable life insurance trust, or it's called ILIT for short, ILIT. In this example, what we're doing is we're using an irrevocable trust and a life insurance policy in combination, and we'll talk about how we are able to avoid estate taxes in doing so. With an irrevocable trust, anything that you place in that trust is no longer yours. That irrevocable trust functions as a separate legal entity. So be mindful of that. If you can't just open an irrevocable trust, start stuffing things in there, and then pull it back out later. That doesn't work. This is an irrevocable trust where you are setting money in there for beneficiaries of the trust, and that is set. You cannot get that money back. That is now in a whole different legal entity for those beneficiaries. So be mindful of that. This is different than a revocable trust where you can make changes while you're still alive. In this case, you're starting with an irrevocable trust that is separate legal entity and it is set once money gets in there. Now, the reason that this is helpful is because once money gets into that irrevocable trust, it is no longer counted in your estate because it is a separate legal entity. Where life insurance comes into play is that you can have the irrevocable trust own a life insurance policy. And you can fund those premium payments to the irrevocable trust. So the way the structure works at a high level, there's a lot of specifics that go into this, but you have a life insurance policy on yourself where you are gifting the premium payments to the trust. So we want to make sure that this is under the annual exclusion limits for gift taxes. You're allowed to give a set amount per year, and that changes each year, but you're allowed to give a set amount per year per person to whoever you want, and you don't have to report it from a tax perspective. So in this case, we can gift that amount to the trust and then have the trust make the life insurance premium payments, knowing that this is going to be a permanent policy. So at some point, you're going to pass away and have a death benefit paid into the irrevocable life insurance trust. So in this way, you can actually have money going into the trust completely tax-free. It's not subject to estate planning taxes, state taxes, as long as you do this planning properly by keeping it under that annual exemption amount. The life insurance trust is able to fund the insurance policy and then get a huge life insurance payout at the end that is not subject to estate taxes, income taxes, any of that. Now, what happens after you pass away in terms of the taxation of the gains inside that trust and the withdrawals and all that other stuff, that is separate. But by doing this structure, we have avoided the estate taxes and given a chunk of money into this irrevocable trust that we no longer have to be worried about being counted in our estate. So it's a great planning tool, very common planning tool. It's not the only way to do it, but this is one way in which life insurance is used by getting a permanent life insurance policy inside the irrevocable trust, funding the trust, and then having the trust make the payments and get the benefit of the payout. The other thing that I will mention that is helpful in this planning is that with an irrevocable life insurance for the beneficiaries, there's also some additional legal protection because this is a separate legal entity. If somebody, let's say you have a son or a daughter who's the beneficiary, and let's say they get sued for some reason. Well, they can't really go after this irrevocable trust money because it is a separate legal entity. So they can otherwise go bankrupt, but they will still have the benefit of this trust, even in cases like a lawsuit. So there may be some legal reasons for you to set this up for your beneficiaries as well. Maybe one of them is a doctor, for example, who has to worry about lawsuits and liability protection. They might be in a really good spot to have this irrevocable trust set up for them because it's protected from a lot of those lawsuits. So just a side note in terms of why trusts can be helpful. It can provide that legal protection as well. So not only have you avoided estate taxes, but you've given the beneficiaries some legal protection as well. The second reason to use life insurance products in estate planning is very similar to what we just talked about with an ILIT, with an irrevocable life insurance trust. But in this case, it focuses a little bit more on special needs planning, which gets pretty deep. We're not going to go way into special needs planning here. That is its own separate area. But I want to let people know that this can also be beneficial from a special needs planning perspective, because functionally, it's going to work very similar to what we just talked about. In this case, you're going to have a special needs trust established, and you can fund the premium payments and life insurance policies in a very similar manner. Now, this is helpful to the person with special needs is because the special needs trust itself, once it has that money from the death benefit, the special needs trust can pay for a lot of the expenses that the person with special needs needs. And those payments, because they're coming directly from the special needs trust, might not count as income or other income or other benefits when the government comes along to determine how much money they need from government assistance. So you can get a little bit of both worlds to where you still have access to the government assistance programs, but you're also having the special needs trust make payments directly for items that you need. So again, I'm not going to go deeply into special needs planning because it is a very complex issue where there's a lot involved. So, but I just want to give people a high level understanding that it's going to be very similar to the irrevocable life insurance that we talked about in the first example, except in this case, you're using what's called a special needs trust, and that special needs trust can pay for a lot of what is needed, and therefore, under that structure, you can still get some of the government benefit payments separately because it's not counting those payments from the special needs trust. So, just a couple of things to think about when we're not necessarily thinking about using life insurance for what we need. We're thinking about after I've passed away, how can I use life insurance to benefit my beneficiaries or especially somebody with special needs?